don't think Chatham House has a room as big as this, but there are a lot of things I could talk about and that we're all interested in, but I want to keep myself to about 20 minutes so that we'll have plenty of time for questions and answers. And so how I thought I would address this question of restoring Ireland's credit, focus on one aspect, which is reducing uncertainty. And I think that's actually one of the most central aspects of the task that's ahead of us in the immediate future. You know, there is a temptation to quantify economic and financial prospects with a lot greater certainty than is warranted. So, you know, what's the growth rate going to be? What's the deficit going to be? What are the banking losses going to be? But especially in the aftermath of events as dramatic as we have seen in the last few years, this can be a big mistake. And all too often, in recent months, projections about the economic recovery, about the budget, and about the likely evolution of banking loan losses have been provided and received without sufficient acknowledgement of the uncertainty surrounding those forecasts. But uncertainty is itself central, not only in our own assessments of future prospects, because we want to know what's going to happen, but the existence of the uncertainty is influencing Ireland's overall creditworthiness, and thereby feeding back on the recovery process itself. Doing what can be done to reduce the uncertainty facing the Irish economy is a large part of what current economic and financial policy is about at present. So I'll just focus mainly on uncertainty around the banks at first, but I'll also touch on some other key dimensions of short-term macroeconomic prospects, employment and output growth, the budget, and cost competitiveness. And taking a chance on this now, but I want to illustrate the points with some charts, which is sort of schematic rather than representing a thoroughly precise representation of our current level of uncertainty. But I want to sort of bring it home to you that there are ways of thinking about uncertainty, and we need to be thinking about these uncertainty. One great visual device for speaking about uncertainty is the fan chart. And here's a fan chart. It's the first fan chart I've seen for Ireland, but you might have seen it in other countries. They've become fashionable. You see a sort of central projection of GDP growth for the years ahead. This is pretty much, the central bank doesn't actually publish multi-year projections, but in the context of thinking about the programme, obviously we were focusing on this. And around the central projection, you see gradually lighter shades of red, indicating what could be possible with a higher level of uncertainty. That's more or less what we expect to happen. And I think it's a better representation to show a fan chart showing the range of uncertainty. It's quite a wide range of uncertainty in our estimate. The central paths shown correspond broadly to those also presented by the IMF and the other institutions involved in the programme. They've committed their institutional funds on the basis of their forecast that Ireland is well able to service even the full amount of the 67.5 billion debt if drawn. Let me show you what the is. That's the growth, but this one is the deficit projection. So you see, again, there's a range. Can't be sure exactly what's going to happen. We know what the budgetary intentions are and what is agreed in the programme, but we don't know exactly how those things will come out. So we have to think in terms of a range. But the fact that the IMF and the EU have bought into the forecasts, to use a word whose relevance and appositeness is more evident now, not less evident, more evident now than it was 6 months ago, they do not consider the debt position in Ireland to be other than manageable. Now, a glance at the bond market yields suggests, however, that market participants are not yet fully convinced that the relatively benign central scenario is the only outcome imaginable. Instead, it seems that investors in Irish government bonds are still factoring in the possibility of what are called, the jargon, tail events. Tail risk. Take tail risk in the banks. In normal times, a well-run bank with good loan appraisal procedures will be able to forecast its likely loan losses fairly accurately, especially if the likely macroeconomic prospects can be pinned down. But when it becomes clear that banks have made substantial underwriting errors across a wide range of their portfolio, to the extent that began to become evident in late 2008, early 2009, the range of uncertainty actually balloons out. And standard valuation practices that work for properly underwritten loans in normal times are pretty ineffective in such an environment for predicting the enormous systemic losses that can occur and indeed, of course, have occurred. And so over the past couple of years, a point estimate for losses, a single number, has been really more misleading than helpful in terms of understanding the range of loss possibilities. Let me show you a series of slides which illustrate schematically. These are a bit maybe novel. And what this is supposed to show is, this is schematic, so I don't put in exact numbers here, billions of euros along the horizontal axis. And up there from 0 to 1 is a probability. So if you go to any point along this point here, what's the probability that the losses will be bigger than this? Almost 0. So only for the very small losses could the probability of the losses being that size or be material. Loan losses are not a big story in profit and loss of banks in good time. They are part of the story, but they're not a big part of the story. That's the normal bank. Now what happens, this might be, the downturn has started. We're in roughly September 2008. We know there's been buccaneering loan appraisal. We know there's been weak supervision. And it's dawning on us the risk of sizable losses. But still the range is small. The probability of being bigger than this is 0.1. So you can put in numbers like this. That might be, I don't know, 20 billion or something like that, or 10 billion. That's what people thought, where people thought they were at that stage. The risk of a rather large and damaging loss, no longer completely negligible. And then it becomes increasingly clear that the concentration of risky loans in property development meant not only that the potential for losses was high, but that the uncertainty around what those losses would be is also high. And that's really what I'm trying to emphasize. And so during the months going into 2009, both the most likely value and the range of uncertainty increased dramatically. So I remember talking at that stage, I was in Trinity College, I talked to a joint office committee on this, and they wanted to know what the loss is going to be. And I said, the range is very high. I said, the plausible range could be as wide as 50 billion between what might be on an optimistic and what might be on a pessimistic. So that's where you're there. That's sort of representing where you are there. Information that could narrow this range was not readily available. But the central bank began to assemble the necessary information through its Prudential Capital Assessment Review exercise, the PCAR process, and from NAMA, because NAMA was actually crystallizing losses on the big loans. And so as of March 2010, you get something like this. The NAMA purchase prices, the first batch were announced, and the central bank has had to go and say, banks, you're going to have to raise more capital because you've incurred these losses, or you are going to incur these losses with NAMA, assuming that the NAMA haircuts are the same across the whole portfolio. So you see what's happened now is that the probability that it can be less than this is kind of negligible now because we've sort of crystallized those losses. So the whole curve shifts out. And then as the summer went on, subsequent NAMA purchases revealed, actually to the surprise of most observers, I think, that the quality of the collaterals underlying the loans made to the middle-level property developers was even worse than that for the large ones. And that, together with the assessment of losses on the Anglo-Irish banks' non-NAMA book, brought us to where we are now. Let's see there. So losses have moved out again, but you see a reducing uncertainty here because we've pinpointed a lot about the non-NAMA losses, about the rest of the property portfolio. So, and finally, what we need now is to reduce the residual tail risk. So we're prepared to accept this. This is what we're left. We know we're going to hit this, or maybe somewhere up here, but surely it couldn't be as bad as this. And this is what the markets are worried about. This is what they think. It could be bad. I don't want to be in this country if it's here. So we've got to provide assurance that it's not here. We've got to lower that curve by collecting more information and being more convincing about our analysis of the information. So hopefully we can get to there, that the market's convinced that the tail risk is more or less gone. So if I run back there, run back through them, you can see what. We start there. A problem, big problem. How big is it? Start to get more precision. We know there's losses now, but we know the loss is even bigger now, but we're getting a little more precision, and then hopefully get rid of the risk. Gradually, the range of uncertainty has narrowed, especially with the last haircuts on the lumpy NAMA purchases. And the important point is not just that the best estimate, I think I'm echoing here. Will I turn off the... The important point is not just that the best estimate of the losses increased, but that the range of uncertainty increased at first and has narrowed, but has more narrowing to do. Ireland faces two main problems in its current financial balance sheet. It has too much debt, public and private, and secondly, there is a market perception of significant tail risk to the debt, especially related to the banks. It is these two problems, which are obviously interlinked, and which have both been growing during the course of the past year, that have led to the market's reluctance to provide continuing funding at reasonable rates of interest. By making an alternative line of funding available, the provision of financial support from the EU partners and the IMF under the programme, what does it do? It buys time for Ireland to reduce these two problems. It does not reduce the problems, it buys time for Ireland to reduce the problems. In particular, the financing provided is not structured to itself reduce the tail risks. That would have been beyond the current scope of the funds from which the financial support has been sourced. Let me digress a little bit on this point. An ideal financial package for reducing tail risk would have offered insurance against the tail risk. Okay, these are big numbers for Ireland, but they're small numbers for the world, or small numbers for Europe. So if there could have been an insurance offered against it, of course there would have to be a premium payable and probably a retained proportion of co-insurance to avoid moral hazard. But an insurance scheme would be even more effective under present circumstances than, say, additional capital into the banks in restoring market confidence, both in the banks to enable them to access wholesale term funding at reasonable costs, and it would also lower the risks perceived by lenders to the state, because we know the state could be on the hook for these. Unfortunately, neither the IMF nor the EU facilities are able to offer insurance of this type as they are presently structured. They are simply lenders. This is a pity, because the wider EU and the global community has a better capacity to bear tail risks than does a single state. Offering such insurance, even at a premium in excess of the fair value of expected claims on such insurance, would evidently be very attractive to a country in Ireland's position for the reasons mentioned. Of course, offering such insurance could expose the providers to adverse selection, moral hazard behaviour, ever the enemies of insurance markets. But these challenges have been overcome in tougher insurance situations by innovations in risk mitigation and control, and I'm sure that they could be overcome in the context of the EU's institutions for financial support operations. Anyway, we don't have that. It's not on the table, although it could be put on the table at some stage. It's a political and technical decision. Absent such insurance, it's not surprising that financial markets have adopted a largely wait-and-see attitude in relation to Ireland, as is evident from the spreads. Actually, I didn't update this exactly. I think this one is probably only up to... oh, it's also fallen off the edge of the screen, so you don't see what happened at the crucial moment. So there's actually not much point in seeing that, because actually it goes up to 6% at the end. It runs back to 1994 here. It's interesting to go back long before we were in the monetary union. Spreads over Germany in those days, just 150 to 200 basis points. Same as they were in the period of the spring of this year before the Greek crisis began. But now have soared up into the 6% area and have stayed around there at the 10-year maturity. So there's a wait-and-see attitude in relation to Ireland. The coming couple of years are thus largely an opportunity for Ireland to, first, deal with the level of debt, and second, demonstrate that the tail risk is lower than has been believed in ways that are under domestic control. So we have to use our own resources to do that, not financial resources, we have to use our own policy resources. So on dealing with the level of debt, Ireland can work to demonstrate convincingly that it has brought the fiscal deficit under control, thereby removing the largest actual and potential source of continuing debt increase. On demonstrating that the tail risk is lower than has been believed, we can further analyse and document the remaining risk exposures of the banks in such a way as to reduce the perceived tail risk And we can also downsize the banks, thereby reducing a myriad of risks, especially if some of the riskiest parts of the portfolio can be divested at reasonable prices. So downsize means selling assets, essentially selling assets. I'll come back to that in a minute. Ironically then, far from removing discretion from Ireland as a sovereign entity, the success of the EU-IMF programme hinges on actions that need to be implemented at home and which, in large part, the public authorities were already planning. Thus, the budgetary measures to meet the fiscal targets both for 2011 and through the following years in the programme are all drawn from the nationally prepared four-year plan. And that's also why we can be confident that if a new government were to want to substitute alternative measures, which were both economically efficient and of equal fiscal effect, it would receive a sympathetic hearing from the funders. Besides, the agreed measures for out years tend to be much less specific and detailed in the programme than those for 2011. So quite a lot of flexibility there. On the banks, the EU-IMF team have in effect endorsed the strategy already being adopted, but they're calling for quicker action. So what is that strategy? Summarise it in 3 points. First, improve in a convincing way information on the quality of the bank's loan books and hence on the adequacy of their capital. This year's Prudential Capital Assessment Review 2011 PCAR will be more detailed and more intense than we were able to accomplish last year. And then that way it'll be more convincing. It'll be published with much fuller detail, also more convincing, and important, it will be validated by external consultants. Aha, expensive external consultants who are already in town adding to demand in the economy at large. Second element of the strategy, shrink bank balance sheets by selling their most distressed and other non-core assets. Okay, so we were already doing this, of course, as we know, NAMA, Poland, USA, and so on. Replenish their risk capital to a demanding standard, seeking new private equity, but where necessary, taking state ownership. So the funders have pressed for firm deadlines on downsizing the banks, packaging and selling non-core and other saleable assets to reduce credit risk and exposure to funding risk, though not at the cost of incurring fire sale costs. We were doing this. They said you should have been doing it faster. You should be doing it faster now. I can't disagree with that. This includes some expansion in the role and streamlining of NAMA, streamlining of the procedures required for its price determination, as well as employing some of the borrowed funds to enhance the credit rating and saleability of portfolio assets. To the extent that assets can be sold outright out of the system, as distinct from being placed in a bad bank vehicle, a sort of NAMA vehicle, then some of the bank's excessive borrowings from the central bank, a legacy of the years of extravagant bank reliance on footloose foreign funding, can be reduced. Third element of the strategy, remove terminally damaged institutions from the market while seeking to retain enough participants to ensure competitive provision of services. This too will be accelerated. As I've often remarked, an effective bank restructuring requires that the fortunes of the banks and the budget be convincingly disentangled. Uncertainty about each damages the other. And despite a promising start in March and April, where the spreads were low, or where people were prepared to buy in to the PCAR exercise, derailed then by the sovereign debt uncertainties, we've not so far been able to achieve this separation. And I suppose that's partly because the initial round of loss measurement, which has depended heavily on NAMA valuations, was completed only at the very end of the initial guarantee period in December. And we were in that period, bubble period of 2 years where everything was guaranteed. We didn't manage to do that, those valuations and that measurement completed until the very end of that. And we were, as mentioned, unlucky in that the sequence in which the valuations came out left the bad news, or the worst news, until late. In addition, the announced losses have been very large and came as a bit of a shock to the market at a time when the state's finances were already under pressure and with heightened market sensitivity, as I mentioned, to the sovereign debt issues in the euro area. A faster and deeper implementation of the existing approach, as agreed under the EU-IMF programme, is clearly the way to go. The funders' single-mindedness on this point will help overcome hesitation and accelerate the making of hard choices. So I won't necessarily agree with every little twist and turn in what they will suggest we do. For example, Given the stressed funding position of the government, I would have hesitated myself to call for an additional 10 billion of capital to be applied right away to further strengthening the bank's capital, as is now agreed. I could go into that at more length, but yeah, I would be hesitating to do that. But anyway, it will be important to ensure that the state gets good value for this investment and that overcapitalisation is not dissipated in cost inefficiencies. Reducing the banking uncertainty will not be accomplished overnight fully. Extracting progressively more detailed and comprehensive information from the banks will help to assess the quality of their remaining non-NAMA book. The evolution of loan performance as the economy recovers will provide further precision. So that's what's going to happen in the next 2 years. Still, even though I would be disappointed and surprised if all of the 35 billion earmarked for the banks in the package were needed in the end, the weaker and uncertain economic conditions now forecast by most observers into the year ahead do underline the need for a strong capital buffer. We'll get a better fix on this with the work that's going on into the PCAR 2011 process, which is intended, of course, to determine any additional capital needs that might have emerged since we last stressed the main bank's non-NAMA portfolio in March 2010. Keeping options open while seeking to reduce the exposure of the state to further risks has been a touchstone of the bank restructuring policy over the past year, and this may indeed have contributed to prolonging the process. Increasingly, it seems evident that placing the continuing parts of the banking system on a firm footing can best be done through the involvement of new foreign owners who can bring capital, risk control and other management skills. This would effectively short-circuit the risk reduction process underway, pull them right out of that whole process. Problem solved. With their due diligence complementing the tail risk reduction envisaged from the capital assessment exercise, PCAR 2011, it's not unreasonable to suppose that such investors will see sufficient franchise value in the continuing banks to convince them that an attractive investment opportunity exists. And I look forward to welcoming new owners of Ireland's downsized and cleaned up banks. Reducing the risks of an underperforming economy also calls for sustained energy and commitment on a number of other dimensions. I've already alluded to the adjustments that have been needed in the other two fundamental pillars of the economy, fiscal balance and cost competitiveness. Both got badly out of kilter in or as a result of the boom years in ways that I don't need to rehearse today. It's a professional deformation. I tend to talk a lot about banking. I don't want to fall into the trap of having you believe that the fiscal crisis is all about meeting the bank's losses. It isn't. To be sure, the fiscal crisis has been brought on by the bank-driven boom and bust. But I hope it is some comfort to be reminded that only something of the order of 1/8 of the fiscal adjustment over the coming years is attributable to the additional debt servicing costs. 1/8. The rest of it is to claw back the budget to where it would have been if the structure of tax and the level of spending had not veered out of what could have been sustained during the bank-driven property boom. So the current impact of the banking losses on the economy is not so much via the net long-term taxpayer cost. It comes mainly as the rapid and sudden accumulation of debt. The accumulation of debt associated with these losses is of the same order of magnitude, it's a bit less, as the rest of the borrowing in 2009-2010. So let's look at that. Here we have percent of GDP. And the blue part is the debt we started with, 25% of GDP. And the purple, that's 2007, 2008, 2009, we start to see some banking losses hitting the debt. 2010, a lot more banking losses. And I put in here the extra 10 billion for 2011, even though it might be paid for out of the National Pension Reserve Fund. So I'm erring on the side of putting a large number for the bank. If there was no other budget deficit going on, that would be our debt profile right through to 2014, 50-something% of GDP, no problem. Now let's look at it from the other point of view. Forget about the banks and, oh dear, I don't know why this, somehow it hasn't come out in the same system. So we have the blue line again, which is the starting point. This time the red, this segment here, that's what the rest of the deficit is contributing to debt. And the top bit is what the fall in GDP is contributing to the debt ratio. So you can see there that if there weren't any bank problems at all, and the bank losses were taken away by somebody else, we would also be somewhat higher. We'd be around the 70-something% of GDP debt. Not really a problem. But it's when you put the two together, and again we have this bar across the middle. I don't know why the orange bar across the middle, but you see it's when you put the banks on top of the deficit that you get into territory that the markets are getting nervous about. The projections are supposed to be consistent with the program there, so you find that the debt peaks around 125% of GDP and then starts to come down. Okay, so that is the projection. Either of the two components, the fiscal deficit or the bank's losses, would have been unproblematic for the debt. Together, they've made the markets and rating agencies nervous. The fiscal adjustment could possibly have been delayed for a year or two had it not been for the banking losses. But now it cannot wait. But it would have had to come anyway. There have been misgivings about the scale of the fiscal adjustment and the withdrawal of aggregate demand that it would entail. Before the EU-IMF programme was agreed, it was clear to all that a less rapid adjustment was infeasible, given the rapidly diminishing appetite of the market for additional government bonds. And now that the programme is in place, some people might say, well, the bond markets can be left for a while to digest their previous meals. But that does not remove the necessity to stay on the agreed fiscal path, because the new lenders, partners though they are, also need to be convinced of Ireland's societal capacity for the fiscal adjustment essential to bring the debt dynamics under control. Besides, a slower adjustment would add to the stock of debt in the long term and worsen the long-term prospects of the economy. Look, the IMF EU programme adds external credibility to the government's fiscal programme, and it should provide assurance that the adjustment is feasible, regardless of any differences of opinion on the likely macroeconomic growth rates. I don't have time to elaborate today on the importance of restoring cost competitiveness if Ireland is to resume exploiting its traditional potential in international markets and more generally in reducing the risks to jobs. I'll do that on another occasion. Remember that the sustainable job growth of the 90s was predicated on wage restraint delivered by the social partnership process. There has already been a deal of adjustment in wage costs, especially in the public sector, but it's not easy to see how rapid job growth can be assured if wage costs are not rolled back on a broader basis from their unsustainable run-up in the early 2000s. The process of rolling back the excesses that have marred the great advances made by the Irish economy over the past 2 decades has heightened uncertainty. In order to underpin a vigorous economic recovery, risk must be reduced, not least by ensuring the conventional elements of fiscal discipline and cost competitiveness, but also through an intensified process of clarifying and crystallising the position of the banks and reducing their exposure. The EU-IMF programme funding provides the window of time in which to restore the fundamentals and reduce the risks, and we're working on it. Let me end on a more philosophical note. If the previous decade had emphasised individual endeavour in a globalised economy, the last couple of years has revealed the degree of interdependence which still exists both in the domestic economy, where the excesses and failures of some have influenced all, and between different national governments, as where local pressures spill over, fiscal pressures spill over from one country to the rest of the euro area, for example. Despite the scale of the official financial support provided by EU partners and the IMF, in the end, it is evidently going to be for Ireland to bear and sort out the consequences of these failures. Accordingly, the national response must be one that achieves a broad buy-in, which requires, among other things, not only fairness, but a consciousness of the unsettling effect of uncertainty on individuals throughout society and a clearer understanding of what is possible and what is not possible to be done in managing these uncertainties. Thank you very much.